When dollar stores start winning, it means everyday Americans are losing. Dollar General just posted its best quarterly results in years. Sales up, profits up, customer traffic up for the fourth straight quarter. They're opening 450 new stores this year alone. Wall Street is cheering. But here on Infinite Capital Mind, we ask a different question. Why are people flooding into dollar stores? What does it tell us about the real state of the economy? And most importantly, how do you turn this economic signal into a wealth-building advantage? Because hidden inside Dollar General's earnings report is one of the clearest pictures of where the American economy is right now and where it's headed. Let's break it down. Welcome back to Infinite Capital Mind, where we decode what's happening in the economy and turn it into action for your financial life. Today we're breaking down Dollar General's Q1 2026 earnings, what the numbers mean, what they reveal about consumer financial health, and the investment and wealth-building lessons hiding inside this report. Here's what we're covering. The numbers, what Dollar General actually reported, why their growth is actually a warning signal for the economy, what this tells us about where consumers are right now, how smart investors and wealth builders read this data, your action steps from this story. Let's get into it. Section 1. The numbers. First, the raw numbers, because you need to understand what happened before you can understand what it means. For Q1 2026, the quarter ended May 1st, Dollar General reported net sales of $10.786 billion, up 3.4% from last year. Net income of $444.1 million, up 13.3% year over year. Diluted earnings per share of $2. That beat Wall Street's estimate of $1.89. That's a meaningful beat. Operating profit climbed 10.8% to $638.5 million. Gross profit margin improved to 31.6%, up from 31% last year. And the company generated $716.2 million in cash flow from operations in a single quarter. They opened 195 new stores, 190 in the United States and 5 in Mexico. They now operate 21,055 total locations across the US and Mexico. They also raised their full-year earnings guidance, now expecting earnings per share of $7.20 to $7.45 for all of fiscal 2026. On paper, this looks like a company absolutely firing on all cylinders. But here's where the Infinite Capital Mind lens kicks in. Because the question isn't just what happened, it's why it happened and what it reveals. Section 2. The hidden warning signal. Here's the part of this story that most financial media completely glosses over. Dollar General's customer traffic grew for the fourth consecutive quarter. More people are walking through their doors than ever before. But who are those people? And why are they there? Dollar General's core customer base is households earning under $40,000 a year, working families, people living paycheck to paycheck, people who shop by price, not by preference. And when a dollar store's customer traffic grows consistently for 4 straight quarters, it doesn't just mean Dollar General is doing well. It means something deeper is happening in the broader economy. Right now, 3 forces are squeezing everyday Americans simultaneously. Force 1. Higher fuel prices. The Iran conflict has pushed gas prices higher. Dollar General specifically cited elevated fuel costs as a headwind, and fuel costs affect everything from transportation to grocery prices to household budgets. Force 2. Tariffs. US import tariffs on goods have raised prices across retail. Budget-conscious consumers feel this most, and they respond by trading down. From Target to Walmart, from Walmart to Dollar General. Force 3. AI and labor market uncertainty. 142,000 tech workers lost jobs in 2026 alone, and that anxiety ripples across the entire working population. Even people whose jobs aren't directly threatened start pulling back on spending when they see mass layoffs in the news. All three forces together are pushing millions of American households toward discount retail. Dollar General's Value Valley program, their lowest price section, posted an 18.4% increase in comparable sales. That's not a small number. That's nearly 1 in 5 additional sales in their cheapest product line. Translation: people aren't just shopping at Dollar General. They're going for the very cheapest things Dollar General sells. That is a real economic signal, and it is flashing right now. Section 3. Practical, empowering, action-focused. Now, here's where we shift from analysis to strategy, because knowledge without action is just entertainment. There are 2 wealth-building lessons inside this Dollar General story. Lesson 1. Recession-resistant stocks are a wealth preservation tool. Dollar General belongs to a category of businesses that financial analysts sometimes call counter-cyclical or recession-resistant. These are companies that do better, or at least hold steady, when the economy weakens and consumers cut back. Think about it. When people have less money, they don't stop buying food, cleaning supplies, or personal care items. They just buy them somewhere cheaper. Dollar stores, discount grocers, and budget retailers capture that trade-down spending. During economic uncertainty, having a portion of your investment portfolio in counter-cyclical companies is one of the most powerful wealth protection strategies available. These holdings tend to fall less during market downturns and provide stability when growth stocks are collapsing. Dollar General pays a dividend of 59 cents per share per quarter. That's $2.36 annually. Not massive, but in a portfolio context, it's consistent, growing income that doesn't stop when the economy slows down. Lesson 2. Learn to read economic signals before they hit your personal finances. Most people find out the economy is struggling when they personally start struggling. Their hours get cut, their salary freezes, their expenses go up, but the data was always there earlier. Dollar store traffic trends, consumer confidence surveys, credit card delinquency rates. These signals appear months before the pain hits individual households. Dollar General's 4 consecutive quarters of rising customer traffic is one of those signals. It's telling you the financial pressure on working and middle-class Americans is real, sustained, and not going away quickly. What should you do with that information? If you haven't already, strengthen your emergency fund. Lock in fixed-rate debt before variable rates move higher. Cut discretionary spending before you're forced to. Build income streams that don't depend on a single employer. Don't wait until the signal hits your own bank account. Read it now. Act now. Let's bring it home. Dollar General posted $10.8 billion in sales, up 3.4%, and beat Wall Street estimates with 2.00 EPS. Customer traffic grew for the 4th straight quarter, but that growth is a warning signal, not just good news for the company. 3 forces are squeezing consumers right now: fuel prices, tariffs, and AI-driven job market uncertainty. Their cheapest product line, Value Valley, grew 18.4%. People aren't just at Dollar General. They're going for the absolute lowest prices. For investors, counter-cyclical and recession-resistant stocks are a critical wealth protection tool in this environment. For everyone, learn to read economic signals early, before they hit your finances. Your action step this week from Infinite Capital Mind. Look at your investment portfolio. Do you have any counter-cyclical holdings? Discount retail, utilities, consumer staples? If your entire portfolio is in growth stocks, you have no protection when the economy slows down. Add balance, add protection. If this gave you value, like this video. It helps the algorithm show this content to people who need it. Subscribe to Infinite Capital Mind for weekly wealth-building content, and drop a comment. Do you shop at Dollar General? And what do you think it says about the economy when dollar stores are thriving?
Keep building.
I read every comment.
Keep
building. Keep growing.